Welcome to the deep dive. Today we are immersing ourselves in the dizzying, high-stakes world of generative AI.
Uh-huh.
If you've looked at the stock market lately, you've seen it. A handful of tech companies driving what seems like almost impossible growth.
Right.
The question hanging over this entire revolution, though, is massive. Are we building the next great technological supercycle, or are we just inflating the world's most expensive bubble?
It truly is the $5 trillion question, isn't it?
Yeah.
And the stakes, well, they couldn't be higher for the global economy.
So that's what we're digging into today.
Exactly. To figure this out, we've gone through sources comparing this current boom, not just to the internet bubble, the late 90s,
Right, the dot-com era.
but crucially, also comparing it to the highly leveraged crisis of 2008.
Okay, that's a heavier comparison.
It is. So our mission today is really to evaluate how legitimate those bubble concerns are and, give you the tools to understand this central tension.
Which is,
Massive, almost unbelievable capital investment pouring into AI infrastructure against these genuine fears that the foundation supporting it all might just be fragile.
let's start there then, with the sheer scale of the investment. Because it's not just big, it's actually changing economic metrics, right?
Oh, absolutely. We're talking about a level of spending that's, well, it's transforming things globally.
Give us the snapshot. Just how big is this spending frenzy?
The numbers are staggering. Global AI spending is projected to hit $375 billion in 2025.
$375 billion.
And then climbing rapidly, potentially reaching $500 billion in 2026.
$500 billion, wow.
Yeah. And this isn't just large, it's kind of warping the economy. The sources highlighted a truly shocking data point.
Okay.
AI-related capital expenditure, that's the money spent on actual stuff like chips and data centers.
Right, the physical build-out.
Exactly. That spending has actually surpassed U.S. consumer spending as the primary driver of growth.
Wait, surpass consumer spending? That's usually the bedrock of the U.S. economy.
I know. It overtook it as the main driver of growth in the first half of 2025.
So what's the tangible effect on GDP then, if AI investment has overtaken the consumer?
Well, the sources estimate that this AI capex contributed about 1.1 percentage points to overall U.S. GDP growth.
Just in the first half of 2025.
Just in H1 2025. That's
Wow.
a massive, really concentrated contribution coming from just one specific technological sector.
And this leads right into that central tension you mentioned, because while AI is carrying the GDP load, the broader economy shows definite signs of stress. We're seeing manufacturing indexes decline, job openings falling significantly.
Right.
And sources noted that, 22 U.S. states are near recession territory?
That's right, 22 states.
So it really makes you wonder, is this AI surge a justified supercycle, a necessary foundation, or is it an unsustainable speculative bubble inflating against a weakening economic backdrop?
And that fragility, that potential weakness underneath is exactly why this deep dive is so essential.
Okay.
To understand this huge concentration of risk and reward, we really have to define what some are calling the NVIDIA state economy.
The NVIDIA state.
Yeah.
Explain that.
Well, think about this. Since the launch of ChatGPT, something like 3/4 of the S&P 500's gains have come from AI-related stocks.
3/4 from just AI.
Yeah. That means the entire market's performance is basically tied to an extremely small number of companies.
And the prime example of this concentration has to be NVIDIA, the chip maker. Let's use that specific data point from the sources to really illustrate their scale.
Okay, yeah. NVIDIA recently became the first company ever valued at $5 trillion.
$5 trillion. It's hard to even process that number.
It is. And to help visualize it, one source pointed out that this single chip maker is now valued as highly as approximately 94 Ford Motor Companies combined.
94 Fords. Wow.
So the term NVIDIA state is used very deliberately. It draws a parallel to, like, petrostate economies.
Okay, I see. Like countries built overwhelmingly on a single commodity, like oil.
Exactly. So if a country's entire wealth depends on the price of oil, any fluctuation is potentially catastrophic.
Yeah.
So the question becomes, if America's growth, and really to some extent the world's growth, is so reliant on the stock performance and continued spending of just a few AI giants, does that vulnerability raise serious systemic questions? Questions that go way beyond just individual stock portfolios.
Yeah, it must. It implies the stability of the whole growth engine depends on whether the demand for chips, which is mostly other big tech companies buying them, is actually real and sustainable.
Or if it's just a massive kind of self-reinforcing bet among a small group.
Okay, let's unpack those risks then. because given that concentration, we absolutely need to move into the warnings and the red flags. Even AI insiders, financial veterans, they're sounding the alarm.
They are.
And the first, most obvious warning sign seems to be this fundamental mismatch, the gap between the investment and the actual current returns.
Yeah, this is what some call the yawning gap. You've got these unprecedented investment levels, trillions pouring into R&D, into hardware, and it's just far outpacing the technology's current pretty modest revenues and profits. It's like it's faith-based financing on a global scale.
And the poster child for this has to be OpenAI, right? They're the epicenter of generative AI, but their financials don't exactly scream trillion-dollar company.
No, they really don't. The number's truly startling when you look at them. OpenAI generated only about $4 billion in revenue last year.
Okay, $4 billion. That sounds like a lot, but...
But their costs, primarily the colossal expense of training and running those huge language models, meant they actually lost $5 billion.
Lost $5 billion, so they burned through a net $1 billion.
That's right. And yet, at the same time, they were floating the idea of an IPO valuation up to $1 trillion.
$1 trillion. Based on what then, if not profit?
Based entirely on future, theoretical productivity gains, not on proven profitability today.
That level of loss for a company aiming for a $1 trillion valuation, it just seems, well, insane to anyone looking at traditional metrics.
It does.
And this cash burn isn't limited to startups like OpenAI, is it? Big tech is bleeding money on this too.
Correct. Even the giants are feeling it. When Microsoft decided to throw its full weight behind OpenAI, that generated significant negative cash flows.
How significant?
Sources noted that Microsoft's AI ventures produced over $3 billion in net losses in just 1 quarter of 2023.
$3 billion in a quarter.
Yeah.
Ouch.
Yeah, and Meta's aggressive AI spending, that likewise spooked its investors because the costs were just so high, and the immediate commercial payoff was, well, minimal.
So even the established behemoths, the ones with deep cash reserves, they're struggling to actually monetize this stuff quickly enough to justify the spending.
That seems to be the implication. They can afford the losses for now, but the question is, for how long?
And that struggle seems to be backed up by that harsh ROI reality check cited in our sources, the McKinsey finding.
Oh, yeah, the McKinsey finding is particularly sobering. Their research showed that nearly 80% of companies actively using AI saw no significant impact on their bottom line.
80% saw no significant impact.
Right. They were spending money on AI integration, maybe buying software, hiring people, but the tech wasn't actually moving the needle on revenue or reducing costs in a really meaningful way. Not yet, anyway.
So the implication is, if these multi-billion-dollar bets placed by big tech, by VCs, if they don't start yielding tangible, measurable returns soon, say, in the next 18 to 24 months.
And that massive market value we talked about, the $5 trillion NVIDIA,
yeah,
it could start to look like a mirage, as one source put it, built on sand.
And here's where it gets really interesting for me. The skepticism isn't just coming from outside analysts looking in.
No.
We have confessions, almost, from the very epicenter of the boom itself.
Yes. The candidness, particularly from OpenAI CEO Sam Altman, is a classic signal of speculative excess, historically speaking.
What did he say specifically?
He openly admitted that investors are overexcited about AI. He warned flat out that someone is going to lose a phenomenal amount of money in this intense infrastructure build-out phase.
He said someone is going to lose a phenomenal amount of money.
He did. He noted many others will overinvest and get burned. It's the hallmark of a bubble, right? Participants know it's frothy. They're aware they're riding a wave of speculation.
But they all think they're smart enough to get out just in time.
Exactly. They believe they possess the unique insight needed to time their exit perfectly before the music stops.
That awareness, that specific warning from Altman, it brings us to a potentially much darker parallel than just the dot-com era, one that links this AI boom to the opaque financing that came before the 2008 housing bubble. This focuses specifically on the physical stuff, the infrastructure supporting AI.
Exactly. This is fascinating and, frankly, a bit worrying. Sources, particularly one in the Atlantic, pointed to the complex financing structures behind these massive data center buildouts.
The server farms needed to run the AI models.
Right. And instead of just traditional corporate loans, big tech firms are increasingly turning to private credit markets and some highly creative securitization methods.
Okay, we need to break down this data center securitization mechanism clearly. The jargon alone sounds intimidating, but it seems critical for understanding that 2008 parallel.
Let's walk through it. It's actually a few steps. First, a private equity firm raises a bunch of capital.
Okay.
They use that money to fund the construction of a big, expensive data center.
Got it. Build the building.
Step 2. They then lease that completed center back to a major tech client. Let's say Meta, for example. And usually for a very long period, maybe 15 or 20 years.
So Meta gets the data center without the upfront costs,
Yep.
and the PE firm gets a long-term tenant.
Right. Then, step 3. Those guaranteed long-term lease payments, the stream of rent Meta is contracted to pay over decades, those payments are packaged up or securitized.
Bundled together.
Bundled together into bond-like instruments, sometimes called data center-backed securities or DCBS.
Okay, DCBS. So investors aren't buying shares of Meta, they're buying the right to collect Meta's rent checks for the next 20 years.
Essentially, yes. And who's typically buying these bond-like things?
Let me guess. Institutions looking for yield.
Exactly. Often large institutional investors. Pension funds, insurance companies, sovereign wealth funds, they're looking for higher yield, long-duration assets.
And presumably these are marketed as pretty safe investments.
That's the key. They're marketed as relatively safe because the underlying tenant, say Meta or Microsoft, is considered highly creditworthy, much more reliable than, say, a subprime homeowner back in 2006.
Okay, so the tenant is solid. This is where the explicit parallel to mortgage-backed securities, the MBS of the mid-2000s, comes in, but with a crucial twist.
Right. Back in 2008, the problem was that risky assets, those subprime mortgages, were bundled, sliced up, and then rated deceptively safe by rating agencies.
Garbage in, garbage out, but dressed up nicely.
Pretty much. Here, with the DCBS, the primary risk isn't necessarily the tenant defaulting. Meta is probably going to keep paying its rent. The risk is the precarity of the asset itself, the data center.
Because of technological obsolescence.
Precisely. Unlike a mortgage where the underlying house generally holds its value or even appreciates over time,
Right.
a data center is built around specific cutting-edge technology, particularly those AI chips, like NVIDIA's GPUs. And those chips, they can become obsolete within just a few short years as new, better, faster generations are released.
So the core assets generating the income, the ability to provide profitable AI computing power, they deteriorate really quickly.
Exactly. The value erodes fast.
So what's the risk then for the pension fund holding that DCBS bond if the chips get old?
The risk is that 5 or 10 years into a 20-year lease, that data center is technologically obsolete. It can't compete.
Meaning the revenue streams needed to support those lease payments could dry up, or the center needs massive, expensive overhauls.
Right, which undermines the profitability assumptions the whole deal was based on. This technological obsolescence risk translates into the potential that the highly rated DCBS eventually defaults. Or maybe just trades at a massive discount because the underlying server farm isn't generating the profits originally envisioned.
And the tech company leasing it might try to break the lease or renegotiate hard if upgrading is too costly compared to just building new.
That's a real possibility. And that exposes the bondholder, that pension fund, to severe loss. It's a subtle but potentially massive difference from 2008. The risk isn't primarily the borrower's creditworthiness, it's the sheer pace of innovation, destroying the value of the physical asset backing the debt.
That is. Yeah, that's a fascinating and slightly scary angle. Okay, let's pivot now to the clearest echo of the dot-com era. That's the market concentration coupled with these financial maneuvers people are calling circular deals.
Yeah, we've already established the extreme market concentration, right?
The S&P game's heavily reliant on a few names.
And that creates herding behavior. Investors chase a limited number of soaring stocks, inflating valuations way beyond underlying fundamentals.
Like in the late 90s.
Exactly. And remember back then, the dot-com crash featured some really exotic vendor financing.
Vaguely. Remind me.
Equipment makers, like Cisco, would lend money to the new ISPs.
So the ISPs could then turn around and buy Cisco's gear.
Precisely. It artificially boosted both companies' reported revenue figures, making everyone look healthier than they were.
Okay, I remember that now. And you're saying we're seeing a modern, maybe even more complicated version of that vendor-client loop with the big AI leaders today.
It certainly looks that way. The sources detail some specific circular financing arrangements that really started raising eyebrows in late 2025.
Okay, like what?
Take the partnership between NVIDIA and OpenAI.
Yeah.
Huge deal. NVIDIA agreed to invest up to $100 billion in OpenAI.
$100 billion just invested in them.
Yeah, providing the capital OpenAI needed to fund massive new data centers. But here's the kicker. In exchange for this funding, OpenAI committed to purchasing millions of NVIDIA's chips over the coming years.
So NVIDIA uses its cash to make sure the data centers get built.
Yeah.
The very data centers that then need to buy NVIDIA's product. It sounds like a closed-loop spending system where the financing basically guarantees the demand.
That's exactly the concern.
How does that arrangement distort the picture of financial health?
Well, it creates a potential distortion on, say, NVIDIA's balance sheet and revenue reports.
Yeah.
When NVIDIA invests $100 billion, that's a cash outflow, an investment.
Right.
When OpenAI then turns around and purchases $10 billion worth of chips using some of that money, that gets booked as genuine revenue for NVIDIA.
I see the problem.
But if that chip purchase was only possible because of NVIDIA's initial investment, is that revenue truly reflecting genuine, independent end-user demand? Or is it just recycled cash moving between partners?
It really sounds like these companies might be functionally subsidizing each other's growth just to project massive revenue and capital expenditure figures out to the market, keeping the momentum going.
That's the worry.
Mm.
And it gets even more complicated when you look at how tightly interconnected this web is becoming.
How so?
Well, just days after that NVIDIA OpenAI deal was announced, OpenAI apparently struck a similar partnership with NVIDIA's main rival, AMD.
With AMD too.
Yeah. And in that case, OpenAI actually took a significant equity stake in AMD in exchange for committing to major chip purchases from them as well.
Wait, so the big AI companies are taking equity stakes in their suppliers and potentially even their rival suppliers. This interconnected web must make it incredibly difficult for investors to accurately evaluate who is actually profitable on their own merits.
It absolutely blurs the lines, doesn't it? Between revenue, investment, equity stakes, all circulating among this small group of highly influential tech companies.
Yeah.
A Bloomberg analysis actually suggested this complex web of mutual reinforcement, potentially totaling hundreds of billions of dollars, really obscures the true financial health of everyone involved.
And the risk is, if one piece falters.
Any eventual unwinding, if one company cancels a massive order or maybe fails to meet a funding obligation, that could cascade through the whole system, making any potential downturn far more painful because these firms are so financially entangled with each other.
Okay, before we pivot to the counterarguments, let's just quickly return to that critical sentiment paradox you mentioned earlier, the Bank of America survey finding. It seems to perfectly summarize the danger zone we might be in.
It really does. So this survey found that 54% of institutional fund managers, the supposed smart money, they believe AI stocks are currently in a bubble. Over half think it's a bubble.
Okay, that's significant, but
UBS strategists reported alongside this that a massive 90% of those very same fund managers, the ones who believe it's a bubble,
90% of them
are still heavily invested in those same AI stocks.
Wow. So they know the music might stop, or at least they suspect it strongly, but they absolutely don't want to be the one who leaves the dance floor too early and misses that final, maybe explosive leg of growth.
That's exactly it. That riding the wave mentality is the classic fuel that takes a speculative mania into its final, most dangerous phase.
It's the ultimate expression of the greater fool theory, isn't it?
Pretty much. I know this thing is overvalued, but I bet I can sell it to some greater fool before it crashes.
And we're seeing prominent voices, people like Jeff Bezos, Sam Altman himself, issuing these kinds of warnings almost simultaneously.
Right, which suggests that even those benefiting most from the boom kind of realize the froth is reaching a critical level. They're trying to manage expectations, maybe.
Okay, that makes a really powerful case for a bubble, complete with echoes of both 2000 and, more worryingly, 2008. But as we promised, we need balance here.
Absolutely.
Why do major financial figures, central bankers even, believe this AI boom might actually be sustainable, or at least fundamentally less dangerous than those previous crises?
Okay, so the primary counterargument really revolves around stronger fundamentals compared to the dot-com era. The argument is, this isn't 1999, where companies were being valued solely on, clicks and eyeballs with no revenue.
Right. Pets.com and the like. What's the official word from policymakers on this assessment? Are they buying the stronger fundamentals argument?
Well, Fed Chair Jerome Powell has explicitly rejected the notion that AI investment is a financial bubble akin to the dot-com era.
He rejected it. What was his reasoning?
He noted clearly, and I'm quoting loosely here, these companies, they actually have earnings and business models.
Okay. That is a crucial distinction. Many of those 90s dot-com firms were pure concept stocks, zero path to profitability. Today's AI leaders, even while investing like crazy, are mostly profitable core businesses underneath.
Exactly. Microsoft, Google, NVIDIA, these are companies making tens, even hundreds of billions in profit already.
And we see that difference reflected in the valuation metrics too, right? Even though they seem high.
Yes. For all the talk of sky-high valuations, the actual numbers are structurally different from 1999, 2000. NVIDIA's forward price-to-earnings ratio, the PE ratio, it's been around 33 lately. Now, 33 is definitely expensive compared to the broader market.
But compared to the dot-com peak,
it's a fraction. Sometimes less than a quarter of the 100-plus PE multiples seen by tech giants like Cisco or Oracle just before the 2000 crash.
Okay, so the valuations are aggressive, yes, but they are at least anchored to tens of billions of dollars in actual measurable profit today, not just hopes and dreams.
Right, that's the argument. It's grounded in some reality, even if that reality is stretched.
So unlike maybe some of the debt-laden startups of the dot-com era, today's big tech leaders entered this AI race with substantial financial firepower already in hand.
Oh yeah, they have cash to burn, as one source aptly put it. Alphabet and Microsoft. They each made over $100 billion in profit last year.
$100 billion.
Meta and Amazon, over $50 billion each. They can absorb billions in AI losses, at least for a while, and they can finance a lot of this massive capital expenditure internally from their own cash flow.
Meaning they don't need to constantly tap external credit markets just to survive, unlike maybe some firms in the past.
Correct. And that provides a really substantial cushion. It helps prevent the kind of sudden credit seizure or funding crisis that characterized past collapses when investor sentiment turned sour.
Okay, that makes sense. And this brings us to what you called the most critical difference from the 2008 crisis. The core funding model. The IMF view seems to be that this boom is primarily equity financed, not debt fueled.
Yes, and this is potentially the systemic shield. Pierre-Olivier Gourinchas, the IMF's chief economist, stressed exactly this point. The AI boom, he argued, is largely not built on leverage.
Meaning it's funded by
cash reserves, like we just discussed, and by equity investors, shareholders buying stock, venture capitalists investing in startups, people who understand they are taking on risk.
Okay. So let's play this out. If AI stock prices do collapse, say they fall 50 or even 70%, who takes the biggest hit?
Well, shareholders lose money. Portfolios shrink significantly, wealth is destroyed, yes, and that can have knock-on effects on confidence and spending.
Right.
But it should not imperil the core banking system. It shouldn't cause cascading defaults across the credit system in the same way 2008 did. Why? Because the risk isn't primarily held in complex hidden derivatives tied to the creditworthiness of millions of ordinary people and businesses.
It's contained mostly within the equity markets, held by investors who, theoretically at least, can absorb those losses without bringing down the banks.
That's the idea. The exposure is also smaller relative to the overall economy compared to past booms. AI investment has risen by less than 0.5% of U.S. GDP since 2022.
Okay, how does that compare to the dot-com run-up?
Tech investment back then, during the 1995-2000 period, peaked at around 1.2% of GDP. So today's AI boom, while significant, is still a smaller slice of the overall economic pie in terms of investment flow.
Interesting. And this is why San Francisco Fed President Mary Daly refers to this situation potentially as a good bubble. Explain that concept.
Yeah, the good bubble theory is quite compelling, actually.
Yeah.
Daly argues that even if investor expectations overshoot wildly, even if valuations get completely out of whack for a while, the resulting investment surge, all that money pouring in, leaves behind valuable, highly productive infrastructure.
Like what?
Like state-of-the-art data centers, incredibly specialized chips, advanced algorithms, and crucially, a much larger pool of skilled workers who know how to build and operate this stuff.
So it's seen as a productive investment for society in the long run, even if the short-term market timing is wrong for some investors, not just wasted speculation like, say, trading tulip bulbs.
Exactly. The idea is, even if many initial investors lose money when the bubble corrects, society benefits because the foundational technology needed for the next decade of progress has been massively subsidized by those overly enthusiastic investors.
It sounds a lot like the argument made about the internet build-out following the dot-com bust.
Precisely. The financial pain was real for investors who bought at the peak, absolutely. But the vast fiber optic networks and the initial server infrastructure that got built during the mania, they remain.
Yeah, ready to power everything that came later, from Google and Facebook to Netflix and cloud computing.
Right. And the same argument applies here. The immense capacity for AI computation we are building right now at huge expense will still exist regardless of whether NVIDIA's stock price holds at $5 trillion or corrects sharply. That capacity will be there for future innovation.
That's a strong point. Now, I hadn't really considered this next factor. The physical constraints of the real world acting as a kind of natural brake on this speculative frenzy.
Yeah, this is a really practical point. Hype can move at the speed of light, right?
Absolutely. Market sentiment can turn on a dime.
But construction cannot. Pouring concrete, laying fiber, building power substations, that takes time.
Yeah.
Lots of time.
So this acts as a moderator. How does that differentiate it from, say, the housing bubble?
Well, in the housing bubble, particularly pre-2008, lax lending standards allowed housing supply new construction to surge almost instantly to meet speculative demand. It was relatively easy to finance and build more houses quickly. With AI data centers, it's different. Morton Wierod, the CEO of ABB, a company involved in electrification, pointed out that while these huge sums, trillions of dollars, are being announced for data center projects, the simple reality is you just can't build them that fast. There's a scarcity of key inputs.
Like what kind of inputs?
Not enough skilled construction workers, particularly electricians. Not enough raw materials like concrete and copper available quickly enough. And critically, the existing electricity grid infrastructure in many places is nowhere near ready to power these absolutely massive, energy-hungry server farms.
Right. I've heard about the power constraints. They're enormous energy hogs.
They are. So this physical scarcity, these real-world bottlenecks, they act as a kind of natural throttling mechanism. It prevents the kind of extreme overbuild where capacity wildly outstrips any plausible near-term demand, which is often what happens right before a bubble pops.
So the supply simply can't ramp up as fast as the hype can, which maybe gives genuine monetizable demand a better chance to catch up eventually.
That's the idea. It puts a speed limit on the physical expansion, regardless of market euphoria. And there's an interesting kind of ironic counterpoint within the technology itself, too.
Which is?
Rapid technological progress, think more efficient chip designs, better algorithms, could actually reduce the need for just infinite hardware scaling in the future.
Ah, so if one new chip can do the work of 10 older chips.
Exactly. Then maybe you don't need to build quite as many gigantic data centers. This could actually prevent a future scenario where we're left with a vast landscape of idle, useless, power-hungry data centers built during the peak hype. Efficiency gains could moderate the physical build-out needed.
Okay, so the optimist view, pulling this all together, is the supercycle thesis. This isn't just speculative mania, it's a necessary foundational investment, like the railroads were, or the widespread adoption of electricity or the internet.
That's the argument from the proponents, yes.
Yep.
AMD CEO Lisa Su, for instance, argues that critics are simply thinking too small. She predicts a decade-long supercycle driven by AI's potential to fundamentally transform literally every industry.
And NVIDIA's CEO, Jensen Huang, he must be bullish too.
Extremely. He insists that the surging chip demand isn't cyclical, it's structural. He says it marks the beginning of a new computing era. They argue that the productivity gains, once they are fully realized across the economy, will easily justify the trillions being spent now on building this infrastructure.
So the ultimate takeaway from the sustainable boom side is, even if current investors lose money in a market correction, the infrastructure, the technology, the capabilities being built right now will remain. They'll be ready to boost productivity across the entire global economy for years, maybe decades to come.
Right, which makes it, in the long run, a fundamentally productive investment for society, rather than just wasted speculation that leaves nothing behind.
That's the crux of the counter-argument, then. The strategic direction of the investment is sound, even if the short-term market valuations might be too high right now. Okay, let's try to put all of this into context by summarizing the risk taxonomy. We've mentioned the dot-com crash, the subprime crisis, even tulip mania briefly. If this AI boom does correct, what kind of historical event are we most likely looking at in terms of severity and systemic threat?
Well, based on the sources, particularly the views from central bankers and economists, we have a pretty clear risk hierarchy.
Okay.
First, the dot-com era, roughly 1995 to 2000. That was characterized by lots of new, often unprofitable startups, and it was overwhelmingly equity financed.
Stock market money.
Exactly. When it burst, the market endured a deep, painful fall. The NASDAQ index dropped nearly 78% from its peak. It caused a mild recession in 2001.
But
critically, no systemic banking crisis. The financial risk was largely contained within the stock market itself. Banks didn't collapse wholesale.
And the AI boom seems to share some of that DNA, right? Rapid tech hype, risk of overinvestment, primarily equity financed.
It does share those characteristics. So the consensus forecast among global central bankers folks at the IMF, the Bank of England, the Fed, is that any potential AI bust would most likely resemble a manageable, though painful, dot-com style correction.
Meaning a sharp market drop, maybe a mild recession, but probably not threatening the fundamental stability of the core banking system or the ability to get cash out of ATMs.
That seems to be the baseline expectation, yes. Now, contrast that sharply with the subprime crisis from about 2003 to 2008.
Okay, the big one.
The big one. That was defined by debt finance assets mortgages, specifically subprime mortgages. It involved complex, highly leveraged products like collateralized debt obligations, CDOs. And critically, it posed a high systemic risk because those toxic leveraged assets had infected the balance sheets of the entire global banking system. It threatened the core.
And the crucial difference here for the AI boom is that it's not built on widespread household debt or these kinds of toxic leveraged assets sitting invisibly on the balance sheets of every major bank.
Correct. The overall leverage embedded within the AI system appears to be vastly lower. The only structural parallel to 2008 we really found in the sources was that securitization of data center leases we discussed.
Right, the DCBS market.
But even that market, while growing, remains relatively small compared to the multi-trillion-dollar global mortgage market that melted down in 2008. It's just not the same scale of leverage permeating the entire system.
Okay. What about the ultimate historical bubble, tulip mania? Any lessons there?
Well, tulip mania, 17th century Holland, is often cited because its fallout, while devastating for those involved, was largely contained.
Contained to whom?
Primarily to the wealthy speculators who were trading tulip bulbs at absurd prices. The collapse caused widespread personal financial ruin among that speculative class. But the broader Dutch economy, the trade, the industry, it largely kept functioning. The analogy here would be that an AI bust might similarly affect mainly wealthy tech investors, VCs, maybe high net worth individuals heavily exposed to tech stocks.
But not necessarily the average person's job or savings accounts, provided the credit channels, the banks, remain intact and functional.
Exactly. Assuming it doesn't trigger a wider credit crunch, the pain could be relatively concentrated at the top end of the wealth spectrum.
Okay, so if the consensus is that the risk is manageable, likely contained to the equity market, more .com than 2008, how do we know if we are currently veering from just healthy, exuberant growth into genuinely dangerous, overheated territory? What are the key indicators we, as informed observers, should be monitoring right now?
That's the critical question. Analysts have flagged about 5 key areas to watch closely.
Okay, number 1.
Valuation metrics, specifically things like the price-to-earnings ratio we discussed. We know NVIDIA's PE is around 33, which is high, but perhaps justifiable given its growth. A serious red flag, though, would be seeing AI companies with negligible revenue, maybe even still losing money, being bid up to multi-billion-dollar valuations purely on hype.
Right. Or if NVIDIA's own PE were to suddenly shoot up to absurd heights, say well over 100, without a corresponding exponential surge in actual revenue and profit growth to justify it.
Exactly. That would signal that investor expectations have completely detached from any plausible future earnings reality. Pure speculation taking over.
Okay. Valuation is one. What's the second indicator?
Market concentration, or really market breadth. We need to monitor the health of the overall rally.
Meaning?
If the stock market rally becomes even narrower than it already is, driven perhaps only by 2 or 3 giant AI stocks while everything else languishes or falls, that signals profound instability.
Because in a healthy bull market, you want broad participation.
Ideally, yes.
Yeah.
You want market breadth, many different sectors and types of companies participating in the games. If the Magnificent 7 tech stocks effectively turn into the Fantastic 2 AI stocks, where just their soaring prices are masking underlying slumps in manufacturing or healthcare or consumer staples, that kind of super narrow, highly concentrated rally is inherently fragile and much more vulnerable to a sharp reversal.
Okay, concentration is key. Third indicator, this one seems unsettling, the GDP dependence metric we touched on earlier.
Yeah, this is a potentially huge concern for overall economic stability, not just markets. Sources cited that estimate suggesting nearly 92% of U.S. GDP growth in the first half of 2025 was attributable just to AI investment and related activity.
92%. That's almost everything.
Almost everything. J.P. Morgan analysts noted that while AI capital expenditure contributed that 1.1% to growth, other crucial areas like non-tech business investment and housing construction were actually contracting, dragging growth down.
So if non-AI investment and consumer spending continue to weaken, leaving AI spending to essentially shoulder all the growth, that feels like a really unsustainable imbalance. What happens if that single growth leg falters?
Well, if that one leg buckles, the overall economic growth could instantly tip negative. You could see a recession triggered not necessarily by a credit shock like 2008, but simply by a sudden halt in this speculative infrastructure spending boom.
So we absolutely have to watch if that dependency ratio continues to climb, if the rest of the economy fails to pick up steam alongside AI.
Definitely. It's a measure of how balanced or unbalanced the recovery is.
Okay, fourth indicator. We also need to scrutinize the corporate earnings themselves, right? Especially from the massive players pouring billions into AI.
Absolutely. We need to look beyond just the headline revenue growth. Warning signs would include major tech firms starting to miss their earnings expectations, specifically because their AI-related expenses are ballooning even faster than their AI-related revenue growth.
So costs spiraling out of control.
Right. Or companies starting to admit publicly that the actual returns on their multi-billion-dollar AI investments are taking much longer to materialize than they initially projected.
And a really clear, telling sign that the boom might be cooling off would be
Significant cancellations or major delays announced for those planned data center projects. If companies start pulling back on the physical build-out due to concerns about cost overruns, or maybe weaker perceived future demand for AI services, that would be a strong signal the peak might be passing.
okay. And finally, that leverage in the shadows we discussed. Even though the overall leverage in the system seems low compared to 2008, we can't completely ignore the growth of those complex debt instruments tied to data centers.
Correct. We absolutely need to scrutinize the growth and, importantly, the quality of those data center-backed securities being issued in the private credit market.
How big is that market projected to get?
The volume of such deals is estimated to potentially hit $800 billion through 2028. That's not insignificant.
No, it's not.
So if that market accelerates too quickly, and especially if we start seeing lower quality issuers getting involved, or maybe less creditworthy tech clients signing those long leases, that could signal trouble brewing beneath the surface.
And any uptick in actual tech sector debt delinquency or signs of strained financing for these large data center construction loans.
That would be a major warning flag. It would signal rising skepticism among lenders and debt investors about the long-term viability and profitability of some of these massive projects.
Okay, so we have the risks mapped out, we have the warning signals to watch. So let's conclude this deep dive by discussing the proactive steps. What needs to be done to potentially prevent a financial catastrophe, even if the market does correct sharply in a more manageable dot-com style?
Right, because even a dot-com style correction is painful and has real economic consequences. The goal, as we said, isn't to derail the innovation itself. It's really to insulate the broader financial system from a severe equity market shock, especially one concentrated in a single sector.
So what should regulators be doing?
Well, a crucial first step is enhancing monitoring and transparency, particularly in the capital markets and the less visible private markets. For instance, regulators should probably incorporate specific AI bubble scenarios into their regular bank stress tests.
How would that work?
They could model how, say, a sudden 50% or 60% decline in the equity values of major tech companies would affect the capital reserves of banks. And, importantly, they need to extend that analysis to the non-bank financial institutions, like the pension funds and insurance companies that might be holding those private debt instruments, those DCBS.
And they definitely need to dedicate more resources to scrutinizing that shadow banking system where those data center securities primarily live, right? Because it's less regulated.
Precisely. Regulators need much better visibility into the details of those private equity deals that are securitizing data center leases. What are the terms? Who holds the risk? If these instruments proliferate very rapidly, regulatory agencies might need to consider imposing higher capital charges on institutions holding them, particularly the riskier tranches, echoing some of the post-2008 rules that targeted complex securitized assets.
Make them more costly for banks or funds to hold, discouraging excessive risk-taking.
Exactly. And given that this AI infrastructure boom is a global phenomenon, with data centers being built everywhere, international coordination through bodies like the IMF and the Financial Stability Board is also really essential for sharing information and understanding cross-border risks.
Okay, that covers the regulators. What about the industry itself? Can the companies fueling this boom manage the risk better through more corporate self-discipline?
They absolutely have a role to play, and they must. Companies like OpenAI, for example, need to increase transparency about their actual commercial traction and performance improvements. Investors need real data to gauge whether billions more in investment are genuinely warranted based on progress, not just hype.
So less focus on potential, more on proven results.
Ideally, yes. And corporations overall should probably adopt more phased investment strategies, maybe tying further massive capital expenditure commitments more directly to demonstrated progress and milestones, rather than just committing tens of billions up front based on projections. And they need to be willing to actually tap the brakes if the ROI lags significantly behind expectations. The era of seemingly limitless spending based only on future potential probably needs to end, or at least moderate.
And what about addressing that risk of redundant infrastructure, building too many data centers?
That's a great point. One excellent recommendation that came up in the sources is for firms to actively explore more shared infrastructure models. Meaning the big cloud companies who are building the largest supercomputers should perhaps offer more third-party access to that capacity. This would allow smaller AI companies or companies in other industries to utilize cutting-edge AI capabilities without every single firm needing to build its own redundant, incredibly expensive data center farm.
That makes sense.
Yeah.
It could prevent a landscape littered with half-empty, energy-guzzling white elephant projects if demand doesn't quite meet the most optimistic forecasts.
Exactly. More efficient use of the resources being deployed.
Okay, any final thoughts on the investor side for our listeners navigating this?
Just the classic advice, really, but it's more important than ever in a potentially frothy market. Diversification and discipline. Investors absolutely must remember the harsh lessons from the dot-com era. Hundreds of companies hyped as must-own back then eventually went to zero.
Even as a few survivors, like Amazon or eventually Google, went on to thrive spectacularly.
Right, so a portfolio that becomes too concentrated in highly speculative AI stocks, especially at peak valuations, could be financially ruinous if things turn. Maintain valuation discipline, ask if the price makes any sense relative to current earnings or realistic future growth. And maybe heed the warnings from experts, even insiders, who are openly stating that not all of this massive capital investment is going to deliver the expected returns.
Okay, so let's try to synthesize our key findings from this deep dive. It seems the AI boom shows clear, compelling signs of exuberance. We see the massive investment, the sometimes questionable circular deals, the cautionary warnings from insiders, all classic hallmarks of past bubbles, particularly the dot-com era.
Yes, those signs are definitely there and shouldn't be ignored. But crucially, the analysis suggests it currently lacks the widespread, cascading systemic leverage that caused the 2008 global financial meltdown.
Because it's built primarily on cash and equity, not on shaky debt spread throughout the banking system.
Exactly, which means the potential fallout, if it's managed wisely by regulators and the industry, should theoretically be more like a healthy, albeit painful, market shakeout.
Right.
One that hopefully leaves behind valuable technological progress rather than a complete financial calamity.
So the main policy goal isn't necessarily to stop the AI innovation itself, but rather to insulate the broader financial system and economy from the shock if market sentiment turns sharply negative on this one very concentrated sector.
That seems to be the focus, yes. Manage the potential bust. Don't necessarily try to prevent the boon altogether.
Okay, that brings us then to our final provocative thought for you, the listener, to mull over. We've established that central bankers seem relatively confident they can prevent a full-blown 2008-style financial crisis if the AI bubble pops.
Right, the focus is on financial stability.
But let's consider the broader economic impact for a moment. If this AI boom continues to essentially starve investment in other vital sectors of the economy, things like traditional manufacturing, public infrastructure, maybe education, healthcare, because it's sucking up so much capital and attention.
As it currently appears to be doing. Remember that 92% GDP growth contribution number?
Exactly. If it's shouldering nearly all the growth in the short term, what happens then? Even if we avoid a financial meltdown.
Well, policymakers face that classic dilemma, don't they? Do you try to quash a potential bubble now, maybe by raising interest rates sharply or imposing heavy regulations, but risk stifling what could be truly revolutionary innovation?
Or do you let it run, hoping the good bubble theory holds, but risk a potentially harsher market correction and maybe deeper economic imbalances later on?
It's a tough balancing act. And here's the final question to leave you with. Even if regulators do succeed in preventing a catastrophic financial crisis from an AI bust, are we simply trading that financial instability risk for a different kind of risk?
Sure.
The risk of long-term, unbalanced economic health.
Meaning?
Meaning, Are we inadvertently building an economy that becomes structurally dependent on the continued exponential growth of just one single technology vertical? And what happens to overall prosperity and stability when that vertical inevitably matures or slows down or hits unforeseen limits? That potential structural dependence, maybe even more than the short-term financial risk, could be the larger, quieter challenge facing the economy today. Something to think about.